Martin Karnovitz, the CFO of Litha Healthcare Group. We're really excited with our year-end results that came out this morning. Our headline earnings per share were up 28% and our earnings per share were up 40%, which is great results. It's kind of expected based on our interim results at the end of June. Our turnover is up 39%, which is expected given that our results last year didn't include the 49% acquisition of Litha Healthcare Holdings, but we're really excited that going forward we should be able to maintain these steady results. If I can, in terms of some of the commitments that we made over the last year or so, just to look at them, one of the commitments was that we were going to provide scale to the old Myriad business, which would enable us to enjoy opportunities in the market and to compete with the other pharmaceutical businesses. We managed to do that with the acquisition of the balance of the 49% from Litha Healthcare Holdings. We also discussed the need to make acquisitions in the pharmaceutical division that we have. And that, again, we made some smaller acquisitions during the year, a company called Goldex, which was effectively incorporated on the 1st of May 2011, and then OTC Pharma, which we acquired on the 1st of December 2011. And then really this pending transaction with Pharmaplan, which is a really medium-sized business, which gives us the scale that we need to compete with the other multinationals. So as far as that's concerned, we're quite comfortable that we've met commitments made to the market over the last year or so. We've simplified the group structure, whereas we've got 3 divisions now, separately identified the biotechnology division, the medical division, and the pharmaceutical division. We're able now to provide a shared service to those 3 divisions and to roll out our strategy on shared services over the next year or 2, which will allow us to be more effective and to reduce costs to the extent that we can. A statement of comprehensive income. Our margins have come down slightly from around it was around 10.2% to 8.3%. The reason for that is because of the mix of the business. Because last year we only had 8 months of the LHH business included, and this year we've got the full year, so obviously our margins would come down slightly because the LHH business had smaller margins in it. The other issue was foreign exchange. We had an exchange rate loss of around 26 million rand, which was due to the currency fluctuations. We do hedge a substantial part of our exposure to the foreign exchange, but this is what came through. 2011 was quite a difficult year from a foreign exchange perspective. We had some big devaluations in January and September. So the margins really, if we took out those forex losses from this year and we added back the gains from last year, our margins would sit at between, say, 9.5% and 10%, which is what we're comfortable with. In terms of the different business units, we've got the medical, biotech, and pharma. In terms of those margins, the pharma business, from an operating margin perspective, which would be before head office costs, is sitting at around just over 20%, which is pretty much in line with the expectations. We have the biotechnology division coming at around 5%, which it would sit at between 5 and 6%. And obviously the pharma division this year was a little bit less than we had hoped. It's sitting at 13%, with last year at 20%. But that really relates to our increased expenditure on the scaling up of the anticipated new products that are going to come through in that division. So really we've spent money anticipating some earnings to come through over the next year or 2 from our acquisitions in that Goldex business and the OTC business. If we look at, say, our working capital numbers, working capital really, our debtors days is coming in at 92 days. Inventory 75, and our creditors at 169 days. So we have, our working capital was a little bit under pressure in this period, to some extent because of some delay in payments from some of the provincial government organizations, which was well publicized. However, we've been in continued communication with the Department of Health, and in essence we were at no stage did we feel nervous about it. A lot of the money has already come in post year end, and we have a commitment that within the next 4 to 8 weeks the balance will come through, and it'll bring our debtors days down to the levels that we would have expected in a normal environment. On the gearing side, our debt to equity ratio is sitting at 23.5%, which is not too high. We're comfortable at levels below 40%. And what we did also disclose is that the gearing with the Pharmaplan transaction is going to come in at, say, 26 and a bit %. So we're pretty comfortable at these levels. Important to note that we do exclude our public-private partnership with the Department of Health from these gearing numbers, because that business is ring-fenced, raises its own debt on its own, so we don't include it when we look at what our gearing exposure is, because it's not a true reflection if we include that.